Welcome to the Finpact Hub, where finance is the tool and impact is the purpose. I'm your host, Janelle Valleni, and I'm so excited to have you join me on this conversation. What if the most powerful force for solving the world's biggest problems isn't charity or government policy, but the global financial system itself? I've always been interested in economics and finance, but people are almost always surprised to know that. Ever since I was in school and deciding on my career, people were always surprised to find out that I was going into finance because it didn't suit my philanthropic nature. But I found a way. Because contrary to what many people think, economics and finance are not just numbers, profits, and balance sheets, but can actually be used for any purpose we put them to. This is why my focus ever since then has been on exploring the intersection of finance and social impact through financial inclusion, social and community development, and environmental sustainability. For each of these causes, finance is the vessel that makes them possible. That is what the Finpact Hub is about. Here is what you can expect moving forward. Expert guests every episode to discuss real case studies where economics and finance were used for social impact and the learnings from the successes, failures, and processes throughout. But for today, I'll be flying solo to talk to you about what exactly the Finpact Hub is about and the topics we'll explore together. Let's start by explaining the continuum of finance and impact. There is philanthropy and grants on one hand, and then traditional investing on the other. What we'll focus on is exactly the middle. In this podcast, we'll be exploring that middle section where the tension between return and impact creates the most innovation. To give you a better idea of what these conversations will be like and to set the tone for the next few episodes, let's talk about financial development and inclusion. Financial development consists of four main dimensions. Let's break it down. First is depth, how large it is, how large the financial system is. Second is efficiency, how well the financial system delivers financial services at the lowest cost possible. Third is stability, how resilient the system is in responding to crises. And fourth is access, in terms of the banking system and financial services, which is our focus for today's episode. When either one of these four dimensions is lacking, we generally see a decline in economic growth, higher unemployment, higher poverty rates, inflation, and sometimes even more crime as a result. And all of these macroeconomic indicators impact people's day-to-day lives. They're not just numbers, they're not just statistics. Let's dive deeper into financial inclusion. Despite the importance of these dimensions, and specifically financial access and inclusion, the World Bank Global Findex report estimates around 1 billion adults worldwide are unbanked. Now you might be thinking, so what? These people might be getting on just fine without the banking system. Let's take a closer look. First, we need to identify that there are actually two types of financial exclusion. Voluntary, where some people feel they don't need banking services because they're financed through a family member, for example. However, there's another group of people who are involuntary excluded. These are the people who live in maybe remote areas where banks are not common, or people who don't meet the minimum requirements to receive financial services and funding from commercial banks. Let's look at a few specific examples. Firstly, let's look at a rural woman, smallholder farmer in Uganda. She's in need of a loan to help her upgrade her equipment and make the season fruitful. However, to get a loan, she would need to travel far out of her village into the city, losing a day's worth of income, and provide documents that she does not have and be met with requirements she does not meet. In Uganda, for example, women account for 70% of agricultural labor but own less than 20% of the land and have drastically less access to formal credit, leaving her excluded from the financial system and depending on either family or friends for funding and leaving the cash and livestock she earns vulnerable to theft, disease, or family pressure. She is the backbone of her local economy, yet she is geographically and economically invisible to the formal system. This is the story of thousands of other villagers in the countries all over the world. This exclusion costs its economies trillions in lost GDP. It traps people in poverty and amplifies inequality, particularly for women, who are 9% less likely globally to have a bank account. It's a systematic stability issue. Informal, cash-based economies are more vulnerable to shocks. Without access to credit, entrepreneurship slows and so does investment, making the economy less productive in the long term, which creates all of the issues we discussed before, macroeconomically. So, if financial inclusion is so important for building system resilience, rising entrepreneurship, and smarter risk-taking, then how do we make it happen? Let's talk about a real case study that was a genius solution to this issue, starting in Kenya in 2007. While Kenya had the same issue, financial exclusion, for the majority of the rural residents that were an integral part of the economy but unbanked, a study showed that 8 in every 10 Kenyans had a mobile phone. And that was the start of the solution. One of the largest telecommunication companies at the time, Vodafone, created a system called M-Pesa. M for mobile and Pesa for money in Swahili. What this system did was that it allowed anyone with a mobile phone to send and receive money through SMS and without needing a bank account. Here's how it worked. M-Pesa became an online system that would recruit kiosk owners, vendors, and supermarkets as agents. Since every village had these agents, they were very accessible. They were everywhere. A client would walk up to the agent in their kiosk and deposit money into their M-Pesa digital account. The vendor would take the money and increase the person's credit on their M-Pesa account so that they now have something called e-float and can withdraw their money as cash at any authorized agent location. M-Pesa created access to banking services without a bank account in each individual's name. It allowed them to send and receive money, so peer-to-peer lending, pay bills, and receive microloans. As you can imagine, that solves so many problems for excluded individuals and re-included them into the financial system. Here's how. The authorized agents collecting the money would then habitually deposit the money into a trust account at one of M-Pesa's partner banks, so that the e-float is always backed up by real cash in the system. Additionally, since it's a trust account, nor M-Pesa, Vodafone, or Safaricom, who now owns M-Pesa, own the account. That means it does not show up in their balance sheets and it's completely separate to their operations. This protects consumers' rights in the case of bankruptcy of Safaricom, since they have no claim over the money. This way, the cash is registered into the system and now includes previously excluded individuals. This allows for more productivity, more financial stability, and hence more resilience in case of shocks. And it creates a favorable environment for economic growth. That was all for today's episode. I hope you've enjoyed it, and I hope to see you next episode with our expert guest discussing macro policy and its importance in making real change using finance in the developmental sector. Until then, please visit my website to learn more about the podcast, more about me, and to stay tuned and up to date with the new episodes coming out. Thank you so much for listening.